Welcome back to Investing Talk podcast. Today we're going to be looking into Lazydays Holdings. You've shared a stack of sources with us: due diligence, financials, restructuring analysis, and our job is to unpack all of that for you. We want to understand the recent numbers, the strategic shifts, and the outlook for Lazydays. It seems like a pretty challenging time for the RV industry overall. Okay, let's get into it.
It definitely looks complex. Lazydays, well, they've been around since '76, right? Operating RV dealerships. Their whole business is sales, service, rentals, new, used RVs plus parts, accessories. Pretty comprehensive. And the current situation, yeah, it's really about them adapting to the market.
Right. And those Q1 2025 results, they really show some of that adaptation, maybe the pain points too.
Yeah.
Revenue first.
Yeah, the revenue figure stands out.
It dropped quite a bit, $165.8 million, down from $270.1 million in Q1 last year. That's steep.
It is a notable dip. And the analysis we looked at, it ties that partly, at least, directly to strategic choices they've made. But here's the interesting part from the financials. Despite that top-line fall, the bottom line, the net loss actually got better.
Better. How much better?
Quite a bit. It narrowed from a $22 million loss in Q1 24 down to $9.5 million this last quarter.
Okay, so losing less money even though they brought in less revenue, that feels a bit counterintuitive.
It does initially.
But that improvement, it shows up in the earnings per share, too.
Correct. Diluted EPS, it also improved. Went from a loss of $1.67 in share last year to just a $1.98 loss per share for Q1 2025. So it's a pretty significant step forward, on a per share basis, even if it's still negative overall.
And adjusted EBITDA, that's meant to show operating performance without some of the accounting noise. Did that follow the same trend?
Yes, it did. Adjusted EBITDA went from a loss of $18.2 million last year, Q1, to a $4.0 million loss this year. So that backs up the idea that, well, while they're still losing money operationally, things are moving in a better direction.
Okay. The reports you sent also flagged that some of the usual metrics, like PE ratio, obviously not applicable with a loss,
Right.
or free cash flow, return on equity, those aren't really available or easy to calculate from this data. Same for price to book, beta. No dividends mentioned either.
That's a fair summary of what we've got. We're really focusing on these core operational figures and the profitability trend.
Makes sense. So, to understand why the bottom line improved with falling revenue, we need to talk about strategy.
Exactly. We have to look at their big strategic move, these divestitures, selling off parts of the business.
Right, the dealership sales. What can you tell me about those?
Well, the reports confirm they sold 5 dealership locations just in Q1 2025, part of their turnaround plan. And there was a specific recent one mentioned, the Mesa, Arizona location. That sale to General RV Center just closed, May 23rd.
Okay, 5 locations. How does selling them actually help the finances, beyond just, making the company smaller?
This is the key. The cash they got from selling those dealerships, they used it to pay down debt, a lot of debt. The analysis points to about $145 million in debt repaid during Q1 just from those asset sales.
Wow, $145 million. That's substantial.
It is. It dramatically cuts their leverage. The goal seems to be improving the cost structure of the remaining dealerships and just getting more stable, financially more efficient.
So smaller footprint, but less debt to service, and I guess lower operating costs from not running those sold locations. The sources also mentioned something positive about gross profit margins.
Yes, that's highlighted as a key strength, actually. Margins improved across all their product lines compared to before.
Okay.
So better gross margins mean they're keeping more from each dollar of sales before overheads. That efficiency boost, plus the lower debt costs, that's what's driving the better net loss and adjusted EBITDA, even with fewer sales.
Let's zoom out a bit. Where does Lazydays fit in the wider RV industry now? The reports called them a challenger facing bigger fish.
They are. It's a competitive space. The reports often bring up Camping World. They're the biggest in the U.S., publicly traded, seem pretty stable. Then there's General RV Center, a major force, especially in the Midwest, and growing. But they're private, so, less transparency there.
And the RV market itself, it's known for being pretty sensitive to the economy, isn't it? Ups and downs.
Very much so. Highly volatile. It tracks things like consumer confidence, interest rates, how much spare cash people feel they have for big discretionary buys like RVs. And the report suggests that cost optimization is a big focus across the board right now, not just for Lazydays. Everyone's tightening belts.
So with all this change at Lazydays, the sales, the debt reduction, the tough market, what's happened to the stock price, the reports mention a decline recently, as of May.
Yeah, the analysis links that stock price, drop pretty directly to the reduced revenue from selling locations. Plus, those ongoing industry headwinds we just talked about.
Mm.
It seems that even though they've made real progress on margins and debt, those positives haven't quite outweighed the market's broader worries or the economic uncertainty, at least not yet for investors.
So the market sentiment is kind of wait and see, cautious.
That seems to be the read from the reports, yes. Mixed, but definitely leaning cautious. You see news highlighting management's turnaround efforts, and their investor relations folks are emphasizing, unlocking shareholder value through this restructuring.
But the stock chart suggests people need more proof.
Pretty much. Investors seem to be looking for more solid, consistent signs of a sustainable recovery before jumping back in.
Okay, if we boil it down based on these sources, what are the main strengths that investors should really notice here?
Strengths are pretty clear from the material. One, they actually executed on the divestitures, cutting costs and shrinking the footprint like they said they would. Two, those improved gross profit margins are real. And three, the deleveraging is significant. Paying down that much debt gives them way more financial flexibility. Their balance sheet looks stronger.
Makes sense. And the flip side, the big red flags.
Well, the biggest one is simple. They're still losing money. Both GAAP net income and adjusted EBITDA are still negative despite the improvements.
Still in the red.
Still in the red. And the other major point is the revenue decline. Yes, it was strategic, but it means they're a smaller company now. So that raises the question, where does future growth come from? Unless they can really boost organic growth at the remaining stores, or maybe look at acquisitions again later.
So what's the outlook then? What do the reports see as potential catalysts or risks going forward?
Potential catalysts really center on continuing the turnaround successfully. If they can stabilize revenue where it is now, or even grow it organically while keeping those better margins, that's the path to profitability. Future earnings reports will be watched very, very closely for signs it's happening consistently.
And the risks that could derail that.
Mostly macroeconomic stuff, according to the reports. Ongoing uncertainty hitting discretionary spending if the economy slows more. RV demand could take another hit. Regulatory changes, supply chain issues are always possibilities too, though nothing specific and new was highlighted there. Oh, and interestingly, the sources didn't mention any big new product launches or anything outside their core business as a potential driver.
We mentioned Camping World and General RV earlier. How do the sources position Lazydays against them now, after selling off those locations?
Right. Camping World is framed as the giant, the stable public player. General RV is the big, growing regional force, mostly Midwest, but private. Lazydays comes across as, well, a regional player with a historically good reputation for service, but definitely in transition. Smaller scale now, lagging behind someone like Camping World nationally after these sales.
Okay, pulling it all together then. The sources wrap this up with a summary recommendation. What did they land on?
The summary recommendation provided in the materials is hold.
Hold, okay. And the rationale behind that, why not buy or sell?
It really reflects that balance we've been discussing. On the one hand, yes, real progress. Costs down, margins up, debt significantly reduced, those are big wins. But on the other hand, they're still unprofitable. Net income, adjusted EBITDA, both still negative.
And the revenue question looms.
Exactly. The revenue drop from the sales leaves questions about future growth. So the analysis concludes that the risks are still pretty elevated compared to the potential upside, at least until they can show consistent profits. The reports basically say keep a cautious eye, watch the next quarterly results very closely for more proof of a sustainable recovery before thinking about a buy. It suggests this is more for investors with a speculative risk appetite right now, given the restructuring and where they sit versus peers.
Okay, so for you listening, what does this all mean? Lazydays is actively changing shape, showing better operations in some ways, and definitely has a healthier balance sheet now with less debt. But getting back to consistent profit and growth after shrinking the business, that path still seems uncertain, and it really depends on what happens in the broader economy.
It does pose an interesting question, doesn't it?
When you look at these strategic moves, Lazydays deliberately shrinking, focusing on cost, slashing debt in a tricky market for discretionary goods. What does that tell us? Is this maybe the playbook for companies in similar sectors when the economic picture gets cloudy and consumers get cautious? Is focused contraction the way to navigate? Definitely something to think about as you watch this sector.
A very relevant question for investors today.
Well, thank you for bringing us all these sources for us to go through. We hope this breakdown helps you understand the Lazydays situation a bit better. Make sure you subscribe, like, and maybe drop a comment. That way you won't miss our next deep dive.